Hey guys, it's Akeem here. So Zillow stock is in for a bumpy ride. So yesterday, in the run up to them releasing their earnings, the stock fell by 11.5%. And then in the after hours and in the pre-market, once they had released their results, it fell by a further 17% to the point where it's now at $71. And if we look just a few days ago on the 29th of October, it was at $106. So that's around a 30% decrease just in the last few days, or 35% even. And if we take it even further out, we can see that on the 12th of February, it was $202, and now it's as low as $71. So that's around a 65% decrease over that time period. So let's get into what has caused the drop. Does this present a buying opportunity, or should you stay clear of it altogether? So you may remember that just a few weeks ago, Zillow management came out and said that in Q4, they are going to be stopping purchasing new property, effectively because they cannot find the labor or the materials in order to renovate and then flip these properties, right? So that was just a couple of weeks ago. And now today in the earnings release, we can see here from the news article, Zillow is to stop flipping homes for good as it stands to lose more than $550 million, and it will lay off a quarter of staff. So in just a couple of weeks, they've changed their tune entirely, and they have gone from we are going to stop purchasing houses for the next quarter to we are going to stop purchasing houses altogether, and we're actually just completely getting rid of the Zillow Offers segment of our business. So a huge change, and the market hasn't reacted well to that at all. So you can see here a quote which reads, "We've determined the unpredictability in forecasting home prices far exceeds what we anticipated, and continuing to scale Zillow Offers would result in too much earnings and balance sheet volatility." And we can see that for itself in the actual earnings release, where it reads here, "Today we announced our financial results for the third quarter, and most notably our decision to wind down our Zillow Offers operations, which will unfortunately involve a reduction in our workforce of approximately 25% over the next few quarters. The decision was not taken lightly, especially considering the hard work and commitment from the Zillow Offers team. Ultimately, we determined that further scaling up Zillow Offers is too risky, too volatile to our earnings and operations, provides too little opportunity for return on equity, and serves too narrow a position or a portion of our customers." Now, the first thing that I have to say about this is I can imagine that a lot of people, so not investors, but people in general, are going to be very pleased by this move, because I think a lot of people don't like Zillow, and Zillow has a bad reputation because they feel like they are pushing the prices of housing up further, which makes home ownership unattainable for some people. Personally, I don't subscribe to that belief, because I think that Zillow and other sort of iBuyer companies only account for something like 1% of house sales or purchases. So I don't really buy into that sort of idea. But nonetheless, I think a lot of people will be happy about the outcome of this. Now, in terms of from an investor's perspective, clearly this decision hasn't been taken well by the market. But I actually think that there are probably a couple of things going on here. I think the first is that I personally don't think that the iBuying sort of segment is a good business model, right? So effectively what they're doing is they're using algorithms to purchase properties and then try and sell them at a greater price once they've either renovated them or do whatever they need to do to try and add some value, right? The problem with that is that using algorithms for something like this is that there's so much uncertainty in a property purchase. So if we think about the sort of variables that would be used in an algorithm, the price that they're willing to pay will be based on prices of nearby properties and the sort of macroeconomics, right? The problem with that is that if you walk into any particular house, there could be a number of problems which will require rectification, right? Which would mean that you might want to pay a lower price. Now, an algorithm isn't going to pick that up. The second thing is that generally speaking, it's a low margin business anyway, which means that you don't have much room for error. And we'll see how that has actually shown up in their results, right? So we'll see that they're selling most of their properties, or they have been selling most of their properties at a loss. And they actually have a gross loss, right? So whatever they bought the property for, take away whatever they sold it for, is actually a loss, right? Which isn't great. And that doesn't even take into account all of their operating expenses. So all in all, I think that the sort of business idea, while in theory it sounds good, I just don't think that in practice it actually works. So I think that's number one. I think the second reason the market has not responded well to this is not necessarily because of getting rid of this Zillow Offers segment, but more to do with the fact that it shows an element of inexperience and possibly incompetence by management. And the reason I say that is because management should have realized a long time ago that this wasn't going to be a profitable segment like they thought it would be, And I feel like it's taken them a long time to actually realize that this just isn't going to work, right? So effectively, we've been in a property bull market since they've started Zillow Offers, which was back in 2018, and they've never made a profit. Now, they always sort of hinged on the fact that they needed to scale and get larger before making a profit. Now, that's not unusual, right? But I feel like when you're selling things at a gross loss, so you're not even making a gross profit, that's before your operating expenses. So when on average, you're buying properties and then selling them for even less than what you was buying them for, I think you should realize a lot sooner that this just wasn't going to work. Anyway, Zillow Group isn't just about Zillow Offers, so it's important to focus on the rest of the business as well, particularly because that is what the business is going to look like going forward. So IMT segment revenue grew by 16% year over year to $480 million, and Premier agent revenue grew 20% year over year to $359 million. So that's solid revenue growth there. Home segment, now this is where the Zillow Offers sits. So we will look at it, but we need to understand that going forward, this segment of the business isn't going to exist. However, revenue of $1.2 billion was below our Q3 outlook, due primarily to renovation and resale capacity constraints, which shifted home closings into Q4 2021 that were previously expected to close in Q3. Mortgages segment revenue grew 30% year over year to $70 million. So clearly their largest segment now or going forward is going to be their IMT segment, which is Internet, Media and Technology. And we can see here that from 2018, it has grown in revenue by 52%, which sounds pretty solid, but you have to remember that 52% is as a total. And when you calculate that on a compounded annual growth rate, it's around 15% per year. Now, considering the fact that like I said earlier, we've been in effectively a hyper bull market for the property market over the last few years, 15% revenue growth, whilst it is good, it's not amazing, right? So it's not a hyper growth stock like people may believe that it is, or people believed that it was going to be following the opening of the Zillow Offers segment, right? So 15% revenue growth over the last few years for IMT is still decent, but nothing amazing. With that being said, their adjusted EBITDA has grown by 248%, which is amazing growth, right? So they've managed to become more efficient in their operations, which has led to higher profitability and then therefore higher EBITDA. So that is very, very good. Just briefly coming back to the home segment results, we can see that higher than anticipated conversion rates during Q3 resulted in the purchase of 9,680 homes, further pressuring our renovation and resale capacity constraints. Effectively, they were buying more property than they actually wanted to buy, which again just seems absolutely ridiculous. You would think that there would be a tight level of control over the property that they're purchasing. Anyway, we can see here that this has resulted in 3,032 homes sold in Q3, below our expectations. We also recorded a $304 million write-down on inventory owned at the end of Q3 as a result of unintentionally purchasing homes at higher prices than our current estimates of future selling prices. Which again comes back to the point that I was making, that their algorithms have been purchasing houses at prices above market rate and then selling them for less than they purchased them for, resulting in a loss, right? So clearly not a very good business plan. And to give you an idea of what that actually looks like in terms of numbers, we can see here that Zillow Offers gross profit was a loss of $245 million in Q3, and average Zillow Offers gross profit per home sold was a loss of $81,000. So effectively, they are losing $81,000 for every single home that they purchase and then sell, which again, terrible business plan. Understand that this wasn't within their plan and that they wanted to become profitable as they scale. But for me personally, with the current technology that is out there, I don't foresee this being a profitable business. And clearly neither do management, which is why they've decided to get rid of this altogether. And then here they've provided us with some Q4 guidance, which I'm going to use when coming up with my valuation for the business. So we can see here that total IMT segment revenues between $474 and $487 million. Home segment is between $1.7 billion and $2.1 billion. And mortgages segment is between $47 million and $52 million. So clearly you can see just how large of a segment in terms of revenue Zillow Offers was. However, that was also contributing largely to their losses. So in terms of adjusted EBITDA, we can see that IMT segment is between, around $200 million. Home segment is expected around a $350 million loss for Q4. And the mortgages segment is around a loss of around $12 or $13 million. So if it wasn't for the home segment, it would actually be a profitable business. So it's not such a bad thing that they're actually going to be getting rid of Zillow Offers. in my opinion. So if we consider what the business is going to be like following the disposal of the Zillow Offers segment, what do we think that the business is possibly or could be worth? Right, so current share price is $71.71. Now that's obviously based on the pre-market price, and that could have moved by the time that this video has released. Anyway, that gives it an enterprise value of around $19.5 billion. Right, effectively what I've done is I've taken the revenue from each of the segments for the 9 months in 2021. I've then added on to each of those management guidance for the final quarter. So effectively this is FY21 results, or expected FY21 results. So we've got home segment revenue of $4.5 billion, IMT segment of $1.8 billion, and mortgages segment of $245 million. So that gives it a total revenue of $6.7 billion for FY21. But then what I want to do is forecast what the business is going to look like going forward, right? So effectively, if you exclude Zillow Offers, in other words, exclude the home segment, we can expect that if there was no growth, right, because I'm not going to think about growth for now because I want to price just right now today, we're looking at $2.1 billion of revenue excluding Zillow Offers. We then need to think about what market multiple might be applied to the business now that Zillow Offers has gone. Now the easiest way to think about that is think about the business before Zillow Offers was set up. So in other words, pre-2018. And so that's what I've done. I've looked at what the multiple was over that time period, over a few years prior to Zillow Offers, and we can see that the average was 7.86. So effectively all I've done is I've applied that multiple. We get an enterprise value of $16.7 billion. That gives us a share price of just shy of $61, which is a negative margin of safety of 15%. I've effectively done the same thing using EBITDA, and you can see how profitable the IMT segment is compared with the home segment. So IMT delivered EBITDA, is expected to deliver EBITDA in FY21 of $833 million, compared with an EBITDA loss of $794 million for the home segment. So absolutely significant difference. So effectively, what is the EBITDA of Zillow, excluding Zillow Offers? You get $825 million. Now, what enterprise value to EBITDA multiple might be applied by the market to come up with a valuation for the business? Now, this one's quite difficult because we can't really go back to sort of historical results. And the reason for that is because Zillow Group has been unprofitable for most of its life, right? So we can see here that the average is a negative number. The reason for that is because it had a negative adjusted EBITDA. So we have to try and determine what we think that a multiple might be applied. Now I've gone with 20. Now in terms of how I've come up with a multiple of 20, and of course this is just an estimate, right? But I think that that's probably fair, given the fact that although the business isn't growing terribly fast, right? So around 15% year over year, in a sort of property bull market isn't that impressive. It's solid growth, but it's nothing to really write home about. However, their margins are really good, right? So when we look at their adjusted EBITDA margins, we can see that in the 3 months to 2021, it was 43%. And in the 3 months to 2020 was 47%. So somewhere around 40 to 45% margins in EBITDA is actually very, very good. So that's why I think an enterprise value to EBITDA multiple of 20 is probably fair for this kind of business. That gives us a share price of just under $60, which again means that even following the slump, according to this valuation, the price is still, or the stock is still overvalued. Now, one of the obvious limitations of this valuation model is that it effectively assumes that Zillow Offers is immediately removed from Zillow Group. Now, that's clearly not the case, right? So we're expecting a $350 million EBITDA loss in Q4 of 2021. And they're going to continue to incur costs for Zillow Offers, which the group is going to have to bear, right? So effectively, this valuation model is assuming that Zillow Offers is just removed from the group and there are no further expenses related to that going forward. Clearly, that's not the case, right? This is a very high level valuation. Effectively, what that means is that while we're coming with a $60 share price today, according to this valuation model, in reality, if you believe in the inputs here, it's actually probably somewhat less than that. It won't be a significant amount less, but it would be slightly less nonetheless. But I just wanted to point out that limitation just in case people are slightly confused as to why we're effectively stripping out Zillow Offers entirely from the business, despite the fact that actually for the next few quarters, it is still going to be in existence, right? It's going to take some time to wind down the business. Anyway, guys, I hope you have enjoyed the video, and until next time, thank you.